Welcome to the SWIB Market Update. I'm Chris Preisler, Communications Specialist for the State of Wisconsin Investment Board, or SWIB. Each quarter, we will talk to SWIB staff about the economy, the markets, and how the Wisconsin Retirement System trust funds are impacted. We'll also discuss how SWIB is working to help the WRS remain among the nation's most resilient pension funds, growing and protecting participants' benefits, and giving them peace of mind to focus on work, life, and the future. Please make sure to subscribe in your favorite podcast app so you don't miss an episode. Share this podcast with your fellow WRS members, and leave a review on Apple Podcasts so it's easier for other members to find the show. Joining us today is SWIB's Head of Funds Alpha, Derek Drummond. Derek, thanks for joining us.
Thanks for having me.
So let's start off. Through the first 2 quarters of the year, Derek, there have been a number of issues that have caused some market volatility and created challenges for investors. I want to focus on just one: interest rates. President Trump has been pushing for lower interest rates, but the Federal Reserve at its last meeting held rates steady. Can you talk a little bit about how interest rates have impacted the markets through the first half of the year?
Sure. So there's this tension between the White House and the Fed because the administration wants to spur growth, keep the housing market going, and increase lending, things like this, for example. And then the Fed wants to make sure that inflation's tame because they actually have this thing called dual mandate. And their mandate is to both try and maximize employment while keeping prices stable, so keeping inflation kind of low. So they're worried that if they lower rates too soon, inflation will go rampant and they'll have a much bigger problem to deal with on their hands down the road. The issue is right now, there's just so much noise in the market. It's hard to know when the right time to lower rates is. And then when you have all these exogenous events like tariffs and wars, it's really hard to know if we've really tamed inflation and if it's really okay to start lowering rates. So what that does in the market, it creates a lot of uncertainty in the markets. And so in things like equities, we've oscillated from extreme optimism with themes like artificial intelligence and energy sectors doing quite well at times. And then we have periods of extreme pessimism like we did in April around the tariff talk and how that might affect future consumption and future growth of companies. And so the stock market and the equity market was down a fair amount. Since then, it's rallied really hard as the tariff talk has kind of subsided. So I think the main thing we've seen in my slice of the world, which is where we try and beat the market or generate absolute returns, is with higher rates and higher uncertainty, people tend to gravitate towards high quality companies and away from low quality companies, which is a really good environment for our business because we're really trying to capture security selection and alpha, as we call it. And when you have good companies going up and bad companies going down, and you have skill in being able to differentiate which companies those are, that's really good for us.
So how do you see all this playing out in the second half of the year? I mean, I know you don't have, nothing is for sure, but what are your thoughts for the second half of the year on how these interest rates and this volatility plays out?
So something's going to come to a head over the next quarter or two, I would say. Basically, the data is going to start coming through from the tariff talks and the tariffs that have been imposed over the next quarter or so. And it's going to start affecting companies, and we're going to see how it's affecting consumers. If those tariffs are creating more inflation and putting upward pressure on prices, what do companies do about that? Do they push through those costs? And if they do, will consumers continue to pay higher prices or will they stop buying? So I think everyone's kind of waiting to see if that one does actually come through and how the consumer reacts to that. And then, there are secondary effects if these prices start going up and the consumer stops purchasing these new items. Well, then maybe companies need to start laying people off. So we're really data dependent. We on our team for the next 3 to 6 months, we think we're going to come into a period where we're really going to see a lot of new data. We're going to see how resilient the consumer is. We're going to see how resilient companies are. And that's really going to kind of help inform the Fed if they are ahead of the ball and they've really tamed inflation, or if they're behind the ball and inflation's come up again and they're going to need to keep rates higher for longer.
So one of the foundational tenets of investing is the value of diversification, especially in turbulent markets like we're experiencing now. Can you talk a little bit about how you saw the benefits of diversification play out over the last 6 months?
Sure. And you're right. There's an old saying out there where you say the only free lunch in investing is diversification. And that really did play out well for SWIB as a whole, but also our division in particular. And I kind of highlight diversification in three core areas. One, there's regional diversification. So this year in particular, we've had an immense value to our portfolio from different parts of the world behaving differently. The other one is by asset class. So you have stocks, you have bonds. In our business, we invest in lots of different things. We invest in commodities, interest rates, currencies, you name it. And again, that was incredibly valuable because when you went through Q2 and the tariff talk, that affected bonds differently than it affected stocks, and it affected currencies differently than it affected different interest rates. The last one I would say is style diversification. And the most common framework people have for style is value versus growth, value investing versus growth investing. And so, what we try and do on our team is we would like to have lots of different styles of investing at any given time because if you do think that the Fed needs to keep rates higher for longer and growth stocks potentially sell off because of that, well, you want to have some value opportunities or some quality opportunities to kind of fill the void. And so we spend a lot of time constructing portfolios from a regional asset class and style basis to really kind of build a nice, steady return stream.
So, in your hedge fund portfolio that you manage, market volatility can often be seen as a positive thing. How are your managers viewing the volatility, and where are they looking to find opportunities with a market that is so volatile?
So, what I say is volatility in and of itself doesn't mean or create alpha or opportunity, but it provides the fuel for alpha or opportunity. And some volatility can be good and some can be bad. And I'll give you an example. So, for example, if things are behaving erratically, but you don't know why things seem to be untethered to fundamentals of the macro narrative, that can be bad. Things are just going in weird directions and you just don't know why. That's not good volatility because we don't have any edge in figuring out when it's going to go back to normal or what fair value might actually be. What we do like, the kind of volatility we do like is when there's disagreement in the market. So when you have players in the markets, buyers and sellers in the market that have a different view on the price of an asset, we do like that because you have rational players behaving differently. And we believe if you can do your homework better, faster, stronger than somebody else, and you are better at figuring out what that fundamental value might be, then over time, when you have volatility and you have dislocations from that fundamental value, you can actually take a position knowing, being confident that it might come back to that fundamental value price that you've determined. And what we're seeing in this market environment, we're getting a little bit of both, to be perfectly honest. There's some idiosyncratic risks out there that happen. We don't know when a war might flare up in certain parts of the world. We don't know when the administration might announce tariffs, but we do see how those actions can change fundamental value. And we think we have edge in being able to determine what the new fundamental amount of value might be so we can take positions to capitalize on that.
So, a key theme in both fixed income and equity markets is the status of the U.S. consumer. What views are your external managers exhibiting in terms of positioning their portfolios based on the views regarding the U.S. consumer?
So this is something I think a lot of people are spending a lot of time on, but our team in particular, because a couple of years ago, we actually leaned into the consumer. We thought that the consumer's balance sheet was a lot better than a lot of corporate balance sheets out there. People's stock portfolios were up, their home was worth more. A lot of people were employed and wage growth was good. And that's worked very well for us for the last few years. Now, what we're starting to see is wage growth is slowing down a little bit. Inflation coming through to prices on goods and services is starting to squeeze the consumer. And we're just starting to see some people can't access the equity in their home as much as maybe they would like. And their stock portfolios have gone up, but they don't want to take money out of the stock market to go and buy widgets. And so you're just starting to see some small cracks in the environment, the consumer spending environment. It's starting to show up with things like, will AI take my job? And what are the impact of other government policies? Am I going to be able to make my student loan payment? And so people are starting to pull back on spending, buying that next TV or that next washer or dryer, or going on that real fancy vacation or cruise or something like that. And what we're starting to see is that the consumer's starting to be a little bit more discerning about how, when, and where they spend their money. And so while we haven't fully sounded the alarm yet, everyone's continuing to watch this data. And we've kind of developed playbooks for both scenarios where it's possible that, inflation starts coming down, we start lowering rates, and the economy is off to the races again, and growth is good. And we also have a playbook for if we really do think that inflation is going to stay higher and rates have to stay higher for longer, and the consumer really does materially pull back, and maybe unemployment does start going up, we have some options in our portfolio where we can take advantage of that phenomenon as well.
Derek, thanks for providing some insight into the economy and the markets. It was a great discussion. Appreciate your time.
No, thank you so much.
And thank you for joining us. The SWIB Market Update is brought to you by the State of Wisconsin Investment Board and produced by PodCamp Media. Branded podcast production for businesses, podcampmedia.com. Editing is by Matt Covarrubias. Thanks again for listening. I'm Chris Preisler.